Startup Investing for Beginners. How to get started. Welcome to the Collektiv Podcast, where we talk about early-stage investing. In this episode, I'm answering one of the questions I hear most often. How do you actually start investing in startups, especially if you're not a millionaire, not in VC, and not surrounded by tech founders? There are a lot of myths and a lot of noise. So let's break it down. What startup investing actually is, who can do it, how to begin, and what to avoid when you're just getting started. Part 1. What is startup investing really? Startup investing is the act of backing early-stage companies with your own money. Sometimes these companies are just getting started. They may not even have revenue yet. Sometimes they're growing fast but still very young. When you invest in a startup, you're typically buying a small amount of equity shares in the company in exchange for a cash investment. And you're doing it because you believe that company will grow significantly in value in the future. If all goes well, your shares become worth much more. That might happen when the company gets acquired, goes public, or raises another round at a much higher valuation. But here's the honest truth. Many startups don't make it. The failure rate is high. That's part of the game. What makes startup investing exciting and powerful is the upside, the access to innovation, and the ability to support brilliant people building new things before the rest of the world sees it. Part 2. Who can actually do it? There's a huge myth in the startup world that investing is only for the ultra-wealthy. That used to be true, but not anymore. Thanks to angel syndicates, rolling funds, and platforms like AngelList, Odin, and Seedrs, you can start investing with as little as £500 to £2,000 per deal. That's still money, of course, but it's a world away from the £25k, £100k minimum. And here's another myth. You have to be a professional investor. The truth is, startups want more than money. They want investors who can give insight, share feedback, open doors, or simply understand the space they're in. If you're an operator, a founder, a marketer, a product person, a designer, your experience matters. Your network matters. Your questions matter. What you do need is curiosity about how startups grow, a willingness to lose the money you invest because it's high risk, a mindset that values learning and long-term thinking. Angel investing isn't trading. It's not about instant returns. It's about being early, being helpful, and being thoughtful. Part 3. How to start. So, let's say you're ready to get involved. Where do you begin? 1. Get access to deals. You need to find a way to see early-stage startups before they go mainstream. Join a syndicate. Follow investor groups on Twitter or LinkedIn. Sign up to platforms like Odin or Seedrs. Or join private groups like ours at Collektiv, where deals are vetted and curated. Don't just wait for a pitch deck to land in your inbox. Go looking. 2. Listen before rushing into your first investment. Join pitch calls, read decks, listen to how other investors think. Ask questions, even basic ones. Learning by watching is underrated. 3. Start small. You don't need to invest £10k to be taken seriously. A thoughtful £1k check with good follow-up and genuine interest will build your reputation faster than a silent big check. You're not just building a portfolio. You're building a reputation. Here are 5 areas to focus on when you're starting out. 1. The founder asks, why are you the one to build this? You're betting on a person. Look for clarity, urgency, and obsession. If they've lived the problem or tried to solve it before, that's a signal. 2. The problem asks, what's broken and who feels it most? You want a real, painful problem, not just a shiny idea. Founders should talk more about the customer than the tech. 3. The solution asks, why now and what's different about your approach? Is it 10x better? Cheaper? Faster? Is it a feature or a business? Can they explain it in one sentence? That's a good sign. 4. The traction ask, what have you proven so far? Even if they're pre-revenue, are people using it? Buying it? Talking about it? You're looking for signals of demand, not just projections. 5. The round ask, how much are you raising, on what terms, and how will you use it? You don't need to negotiate terms as a beginner, but you do need to understand how your money is being used and where you sit on the cap table. 5. Diversify, don't put everything into one startup. Most angels lose money on some bets and win big on just a few. Think about building a portfolio of 10-20 over time. Small bets, thoughtful notes spread across sectors or stages. Final thoughts: investing in startups is not about being rich or lucky or part of a secret club. It's about being curious, staying close to innovation, and backing people who are building real things often before anyone else believes in them. You don't need permission. You just need to start. So, find a network, join a call, read a deck, ask a question. That's how every great investor begins. If this helped you, share it with someone who's been curious about angel investing. And if there's a topic you want us to cover, from evaluating founders to spotting red flags, drop us a message. Thanks for listening to the Collektiv Podcast. Until next time, keep backing bold ideas.